What's up guys, Rick here, and in today's video we're gonna compare two ETFs which are probably the best ETFs around. I'm talking about VOO, the glorious S&P 500 Index Fund ETF from Vanguard, and the growth ETF QQQ, which is the Invesco QQQ Trust Series 1. I personally love both, although being a European investor I don't have access to QQQ, while luckily everybody has access to the S&P 500 index. If you've seen my last comparison SCHD VOIM a couple of weeks ago, I'm going to use a similar structure by grading 6 different aspects of the ETFs, and at the end of the video we'll also tell you exactly what would be my approach in choosing between VOO and QQQ and what would be yours. So now let's go right to the first aspect, which is the strategy. VOO represents the large cap markets contained in the S&P 500 index, which includes all sectors in which the percentage weight of the companies reflects their market cap. So for example, a company like Apple with $2.82 trillion market cap is going to have a higher weight than a smaller company, even if the smaller company were to have better returns and growth. The 500 companies of the index are selected by a committee from Standard & Poor's, and to qualify they must have a market cap of at least 12.7 billion at the time of recording of this video, the value of its market capitalization trade annually. So for example, if a company is worth $20 billion, it needs to have at least 20 billion traded every year, at least 250,000 of its shares traded in each of the previous 6 months, most of its shares in the public sense, be at least 1 year in the stock market, and have a positive sum of the previous 4 quarters of earnings. On the other side, QQQ is also cap weighted and tracks the NASDAQ 100 index. And what is the strongest sector in this index? Information technology. Now don't get me wrong, technology is also the heaviest sector in VOO, but in QQQ it's gonna cover 58.75% of the total weight. The ETF includes about 100 of the largest domestic and international non-financial companies listed on the NASDAQ stock market based on market capitalization. And they must meet the following criteria: being listed exclusively on NASDAQ, being publicly offered since at least 3 months, having an average daily volume of 200,000 shares, being current in regard to quarterly and annual reports, and not being in bankruptcy proceedings. When it comes to strategy, VOO manages to catch many more valuable companies, and the strategy is more sophisticated than QQQ. For this reason, I'm gonna give 9 points to VOO and 8 points to QQQ. The second aspect is the expense ratio. And before giving you the results, in case you're interested in these kind of videos, be nice and don't forget to subscribe to my channel and ring the bell so that you'll be notified of future ones. So, when it comes to expense ratio, here we have a clear winner. VOO has an extremely low expense ratio of 0.03%, which makes this ETF one of the cheapest on the market, while QQQ has an expense ratio of 0.2%. That means that for every $10,000 you possess, VOO would cost you $3 per year and QQQ 20. I know the difference doesn't sound like a lot in a 1-year term, and in fact, I believe that it's not so dramatic. But to give you some real numbers, let's assume now that you invest $10,000 in each ETF, and for the sake of this comparison, both ETFs grow in the next 30 years with the same average return of 10%. In this case, even though the difference between the expense ratios is just 0.17%, the difference in growth of the two portfolio is going to be 5%. Or $8,600. Maybe it's not the end of the world, I know, but it shows you that a small percentage of difference in the expense ratio causes a much bigger difference in final results. So for this reason, I'm gonna give 10 points to VOO and 8 points to QQQ, making VOO the leader with 19 points and QQQ following with 16. The next aspect is the risk-adjusted ratio. And to analyze this, we're gonna use the so-called Sharpe ratio. I used the Sharpe ratio also in the other comparison video that I made a couple of weeks ago. But for those of you who haven't seen it, the Sharpe ratio is a measure of the risk of an investment, and this is calculated by comparing the return of an investment to that of a risk-free asset, adjusting with the volatility. The advantage of using such ratios is that you manage to crystallize into a number something that takes into account not only the return of an investment, but also the risk involved. So basically, the greater a portfolio Sharpe ratio, the better its risk-adjusted performance. And if we use the website portfolioslab.com to compare it to ETFs, we find out that QQQ, which is the blue line, has had a higher Sharpe ratio overall in times of growth, and a lower Sharpe ratio only in times of bearish markets like the one in the last 2-3 years. Zooming into last year, we noticed that around April, QQQ's Sharpe ratio has surpassed VOO and got to 0.51 against 0.2. Now, of course, this doesn't mean that QQQ is less volatile than VOO. In fact, QQQ is more volatile with a total volatility of 4.60% against 3.38% of VOO at the moment. Now, the return of QQQ has been so much higher than VOO that the higher risk pays off on average. By the way, I could have used beta to show you the volatility, but we would have come to the same result. Considering the general trend of the last 10 years, and the current ratio of the two ETFs, I'm going to give here 4 points to VOO and 7 points to QQQ. That results in 23 total points for both ETFs. The next aspect we're going to look into is diversification. VOO contains 505 different companies, while QQQ has 102 holdings. And not only QQQ has only a fifth of the companies, but it's strongly focused on one single sector, technology. In fact, at the time of recording, technology weights 58.75% of total QQQ portfolio. Now, you may argue that this is not a bad thing because the technology sector is the strongest growing sector, but it does reduce the diversification of QQQ compared to VOO and exposes you to a higher risk should the technology sector underperform like it did last year. VOO, on the other hand, has a much more balanced distribution on the sectors and contains the financial sector that is completely missing by QQQ. And for the growth lovers like me, VOO still gives you an overweight in information technology with 25.80%. By the way, if you invest in QQQ and you're looking for a way to integrate the financial sector into your portfolio, you may choose an index fund like the NASDAQ Financial 100 Index, ticker IXF. Now, considering the sector exposure of these ETFs and the total number of holdings, which for VOO is 5 times higher than QQQ, when it comes to diversification, I'm gonna have to give 9 points to VOO and 5 points to QQQ, bringing VOO to a total of 32 points and QQQ to a total of 28 points. Well, let's move on now to the aspect number 4, which are the holdings. If we compare VOO and QQQ, we notice that there is a significant overlap between the two ETFs. In fact, except for 3 positions, the rest includes the same companies. In VOO, we have Berkshire Hathaway, ExxonMobil, and United Health Group. In QQQ, we have Tesla, Broadcom, and PepsiCo. Now, as much as I like the energy sector and therefore even ExxonMobil, which by the way pays a dividend yield of 3.41%, I appreciate the weight of Tesla in QQQ as well as the inclusion of PepsiCo in the top 10. For this reason, I'm gonna give 6 points to VOO and 7 points to QQQ, bringing VOO to a total of 38 points and QQQ to 35. Alright, let's jump to the last and probably most important aspect, which is the performance. As you can see, in 2023, QQQ is leading with an incredible return of 34.40% at the time of recording. Here instead you see the returns of the past decades for both ETFs. And again, QQQ outperformed tremendously since 2013, with a total of 430.24% compared to just 213.90% of VOO. Not only QQQ returned such an incredible result against VOO, but it did it even compared to other purely growth ETFs like the Vanguard Growth ETF VOG. If you want to find similar results to QQQ, you need to buy pure information technology ETFs like VGT from Vanguard, which in the last 10 years gave us comparable results. Now, before jumping to conclusions, I want to show you what happened instead to growth companies between 1998 and 2009. And to do this comparison, I'm going to have to take the SPDR S&P 500 ETF Trust rather than VOO, because VOO didn't exist yet. The two ETFs are essentially identical in holdings, so it doesn't make any difference. As you can see, the blue line, which is the S&P 500, outperformed the growth ETF QQQ by a long shot, losing a total of only $1,000 compared to $5,000 loss of QQQ for a $10,000 investment. What you see here in the beginning of the 2000s is the end of the famous dot-com bubble that started in the late 90s and was basically after the internet came out and became a big thing. In that period, growth and in particular technology stocks became so overpriced that when the bubble popped, they went down like 80% and it took them over a decade to get back to having a better return than value. Putting the two periods together, 2000 to the present, you get this result. And you can see that despite a wonderful growth of the last 10 years, the S&P 500 performed better for most of the time, and eventually they reached a pretty similar total return. So what do I want to say with this? When you invest in an ETF, you need to have clear in mind for how long you're going to stay invested. And in case you invest in a sector ETF or an ETF like QQQ that has an overweight in a sector, it's important to understand the long-term market cycles. For example, if we take the performance of growth and value since 1928 to today, we see that over the long term, value slightly outperform growth. But on the other hand, it's also true that the invention of the internet created a new world where tech stocks could potentially dominate the market for the next foreseeable future. Now, I want to tell you exactly what would be my approach in choosing between VOO and QQQ and what could be yours. And this is probably going to be the most important part of the video, but before doing this, let me rate the two ETFs on performance. I'm going to give 8 points to VOO because still in the long term, VOO gives a wonderful return, and 10 well-deserved points to QQQ. This brings VOO to win the contest with 46 points against 45 for QQQ. Alright, and in the end I had to give the victory to VOO because as much as QQQ gave a better performance in the last 10 years, and for sure would have made much more money to any of us than VOO, the S&P 500 index keeps being the best, most diversified index around. But still, it's not like you have to decide, right? You can still hold both. So let's see now what would be my approach and what could be yours. First of all, you need to consider how much trust you give to the growth sector, and in particular the technology sector, in the long term. The more you trust it, the more portion of your portfolio can be made out of QQQ. Then you must also consider some other factors. First of all, tech companies grew a lot, not only because they had better profits, but also because more is expected out of them in the future. So you're basically paying them more than what they produce because the market has a lot of trust that are going to grow faster in the future. This is clear by seeing the price to earning ratio by sector, which is the highest for technology. That means that on average, the price of the technology sector in the stock market is 35 times higher than the earnings that they're getting. The second consideration is related to the first one, and is that if now there is so much trust in the technology sector that everybody's ready to pay 35 times more than the earnings, it doesn't mean that it's always going to be like that. Imagine, for example, if you were investing in 1999. Tech companies had an incredible PE ratio and were growing for years without stopping. So obviously, you'd think this would go on forever. If you did invest in them though, after the crisis, you'd have needed almost 10 years just to get to the same value that you invested at the beginning. And who knows, maybe the same is going to happen in the future again after the last 10 years of growth. Nevertheless, as I mentioned before, internet might have been a game changer. And in my opinion, in this century, tech is going to outperform all the other sectors in the long term. So to conclude, since VOO also contains almost 26% of information technology, which gives you a balanced overweight on this sector, a good approach would be to use VOO as the basis of your portfolio and add a portion of QQQ based on your predisposition to risk. Alright guys, let us know what you think and also if you possess any of them. I'd love to know your opinion, so just write it down in the comment section below. And of course, if you enjoyed this video, don't forget to subscribe to the channel because it's just a click, but it gives you access to weekly videos on finance and investing. And also because it's a cool thing to do. Anyway, thank you all for watching until the end. I wish you a great day, guys. And as always, I'll see you in the next video. Ciao.